All right, good morning everyone. I'm James Smith, I'm Chief Economist here at the Resolution Foundation, and great to have you with us this morning. So today we're encouraging you to put aside your Middle East doom scrolling, if just for a few minutes, and talk about something different. We're talking about the housing market and particularly first-time buyers this morning. Now, let me be clear, we will talk a bit about the war, so you won't get away from it completely, but we are trying to be a little bit different here. So, in particular, we're going to focus on who gets credit and who doesn't. And that's the subject of and I'm pretty biased here, a great new paper here that we're launching today from the Resolution Foundation. That's been supported by Nationwide, to whom we're very grateful. And we're going to discuss that report this morning. In a moment, Hannah Aldridge, Senior Research and Policy Analyst here at the Foundation, will take you through the highlights of that report. And then we say this a lot at the Resolution Foundation, but we have a stellar panel here to discuss all things housing and credit related. So first we have Sarah Breeden, who is Deputy Governor for Financial Stability at the Bank of England. Sarah is a member of the Monetary Policy Committee and the Financial Policy Committee, and has basically had every major job to do with regulation and financial risk. So Sarah's pretty busy at the moment, so you should understand. So we're very pleased to have Sarah with us and thank her for her time. We have double Sarah, because we also have Sarah Harrison, the Chief Executive of the Building Society Association. And she was appointed last year after having around 30 years of experience in public sector jobs, holding lots of top jobs in the civil service. So that's a very super relevant background to all this as well. And finally, we have Neil Hudson, who is founder and director of Residential Analysis, who is a font of wisdom, certainly for us at the Resolution Foundation, on all things housing market related, having held many positions in the sector and written too many reports. I actually started with a list of Neil's reports, but I realised we needed to talk about something else. So very pleased to have you all with us. Very welcome this morning. Now, for those of you watching online, there's the opportunity to ask questions on Slido. The slightly ominous sounding hashtag is stopping dreams. So we'll unpack that a bit for you. So that sounds bad, but things aren't as bad as all that. And there'll be time for questions from people in the room as well. So without further ado, I'll shut up and let Hannah get on to telling you about the report.
Okay. Thanks, James, for the introduction. Thank you to Nationwide for generously funding this research. And thank you especially to Simon Pittaway, the co-author, whose analysis I will attempt to do justice to presently. So apparently a really good hook to start a presentation is a controversial statement. But I'm going to start with an utterly benign one. Financial crises are bad, and this chart shows that. But broadly, I'm not going to unpack it in detail, but the dotted line here essentially shows the UK's economic growth after the financial crisis in 2008. And the red area there shows the kind of what's typical for an advanced economy after a crisis. So broadly, the UK just had like a really bad global financial crisis. And after that, we didn't want this to happen again. So various financial regulations were introduced, constraining lending of banks. And this was a very rational response. So, not only is this a benign statement, but it's also old news. Why am I talking about it? But I'm talking about it because, the most obvious and direct way that these financial regulations affect people every day is through access to mortgage credit. And since the financial crisis, the number of mortgages has come down. So that's what this chart shows. It shows the number of mortgages over time, or number of mortgages, so these are people, over time since the financial crisis. So it's indexed to the financial crisis in the middle there. You can see these lines are coming down before the financial crisis, but for the blue line in particular, it continues to tank afterwards. And the blue line is those in the second and middle income quintile. Whereas for those higher up, it's recovered somewhat and seems to be improving. So this kind of matters because housing costs or home ownership is something that the majority of people aspire to. It also helps put your housing costs in a downward path over the life course, build up property wealth, and it has implications for the government as well. If there are very few mortgages, then that poses a problem in terms of people retiring with high housing costs. That sort of has high implications for the benefit bill as well. So what we aim to do is kind of tease out to what extent are financial regulations stopping that blue line from coming up. So our methodology, essentially, we've created a model to answer this question and to look at the constraints that are facing first-time buyers today when they try and get a mortgage. So to do that, we need to identify a few things or create some definitions. So we need to identify potential first-time buyers. We take a broad definition, so we don't want to exclude people who might potentially want to own a home. So we include people who are aged 21 to 55 who don't currently own a home and are working. There's a few nuances, but you can read the report for that. And then second, we need to define what's a starter home, how much would they need to borrow in order to get to get a mortgage for a home. And so we take the lower quartile value of a terraced home in each region. Again, this is below the average first-time buyer price, but what we're looking at is whether or not sort of access to credit is the constraint here, rather than people just wanting to buy higher value properties. So then we model the tests that the tests that first-time buyers need to overcome in order to access credit. And these sort of three tests that we look at are based on the restrictions that are applied to lenders by the rules that the bank and the FCA have asked lenders to adopt. So the three tests are the loan-to-value limit, which essentially just means you need a 5% deposit. The loan-to-income limit, which is that you can borrow up to 4.5 times your income, but some people with higher income can borrow more than that. And then the affordability test, which is essentially banks trying to assess whether or not you could keep paying your mortgage payments if interest rates went up. So we throw all of this information into a model, and this is what we get. There's a lot to unpack here. I'll talk you through it. So what these lines show is the proportion of potential first-time buyer families who are able to overcome each of these tests. And they're split across the income distribution. So the blue lines here look at the tests that look at income. So that's the loan-to-income ratio and the affordability stress test. You can see it goes up with the income distribution. That's not a particularly big surprise. The main point here is that the red line is much, much lower, and that's the number of people who have a 5% deposit on a starter home. And the main takeaway to get from this is essentially, of those 8.3 million first-time buyer families, just 11% of them would be able to get a mortgage on a starter property in their current situation. About half, just under half of them pass the income test, but it's the deposit constraints that are really affecting them. Just 15% have enough to get a deposit. And deposits are so constraining because of rapid house price growth. So this chart aims to illustrate that. So what it shows is the proportion, or a deposit as a proportion of gross median salary in each region. Annual median salary. So essentially, if you're in the East Midlands, you'd have to save, in 1997, you'd have to save 9% of your gross salary in order to have a deposit. In 2005, it's 20%. So this doubling has happened pretty much in every region across England and Wales. But this is a really kind of murky way of talking about how to save for a deposit, because essentially couples can pool their income and get there faster. People who live in the rented sector have a lot less to save after they're paid for their rent. So what we also do is look at how long would it take to save if all these potential first-time buyers saved 5% of their income after tax and housing costs. And so the typical person, it would take them 5 years to save for a deposit. There's about 1.7 million of our first-time buyers. It would take over a decade. Given this, it's not that surprising that about a third of people who do manage to buy a home do so with help from their parents. But also, given these big barriers, you might think, like, how can we loosen credit constraints to help people borrow more? And actually, indeed, that's what we've already seen. So this chart looks at the impact of two decisions that are recently, decisions that are taken somewhat recently by the FPC and the FCA around how the stress test is applied. So essentially, the blue line here is the stress test line that you saw two charts earlier. And then the red line is essentially how the proportion of people who would have passed that stress test if the norms of a couple of years ago were being applied today. So broadly, what we see is actually that line's gone up by about 10 percentage points, particularly affecting those in the middle. So, given that, should we go further? I've got a quote here, because apparently the Chancellor seems to think that we should. In her 2005 Mansion House speech, the Chancellor said she has planned to roll back regulation that's gone too far in seeking to eliminate risk. So, should we go back further? Looking at debt-to-income ratios, or debt servicing ratios that first-time buyers are facing, it doesn't we kind of come to the conclusion that wholesale loosening seems fairly risky. What this chart shows is those ratios of first-time buyers over time, and in 2025, it's sitting at about 22%. This is historically high. The only time it's been higher than this has been preceding a housing crash. Essentially, if you look at this chart, it doesn't make you think wholesale loosening is necessarily a way to go. And if you weren't that bothered about risk, there's another reason why you might not want to go here, is essentially wholesale loosening of mortgage credit isn't a very effective way of increasing home ownership. So this is some analysis that Bank of England have done. Essentially looks at the impact that a 1% increase in mortgage credit has on the housing market. So on the left, you see the impact it has on housing prices. So they go up by 0.6%. On the right, it shows the impact it has on home ownership. That seems to not change at all or potentially go downwards. So generally, we kind of conclude that loosening credit isn't necessarily a good way to go in terms of, or wholesale loosening of credit restrictions isn't necessarily the way to go if you want to increase home ownership. So if you're not going to do that, what could you do? So broadly, we conclude that the barriers that first-time buyers are facing are a function of high house prices. And the way to deal with that is to build a lot more homes over many, many years. That's going to improve affordability and living standards in the longer term. But it's not going to help the people that I'm talking about overnight. So we've identified 3 areas where we think there's room for improvement. The first one is adjusting the lending rules to base it on net income instead of gross income. Partly just because net income is a better measure of how much people can afford to spend on their housing. But also, in a progressive tax system, basing things on net income is going to be better for people towards the bottom of the income distribution. We also think that the Bank of England should routinely publish impact assessments of its macro-potential tools and how it affects different groups in the way that we've kind of attempted to do here. But these are generally tweaks to the financial system, and these aren't necessarily going to be game changers. But what we think could be game changing is if the government steps in. And we're proposing a highly targeted deposit support scheme. And the people that we think this should really focus on is 1.1 million potential buyers who essentially they lack the savings to overcome that deposit barrier, but they could afford to pay a mortgage, and essentially they're already paying more than their mortgage would be in rent. So if you can target this group, you'd improve their living standards considerably. So we're proposing what we're calling a starter deposit scheme. Essentially, it would provide first-time buyers with a loan from the government worth up to 5% of a starter home deposit, so long as they're able to secure a mortgage on the rest. It's not Help to Buy, which is also an equity loan scheme. Help to Buy, this is different in 3 particular ways. So it's available on existing properties, not just new builds, which typically come at a premium. The buyer wouldn't need to contribute their own savings, which is what happened with Help to Buy. They have the option to contribute up to £3,000 of their own if they have it. And then the loan size would be capped at 5% of that starter home price, which is essentially a relatively low price cap. So we think we can't it's quite practically difficult to exclude people with access to BOMAD, but with price ceilings at this level, so you're very unlikely to access it. Why would you take on unnecessary debt if you don't have to? And also if it prevents you from buying a higher value property, which you might like to do. But if you're able to access our target group, we think that they would save, on average, sort of £2,600 a year in lower housing costs and also build up property wealth at the same time. So our key takeaways is that the constraints facing today's prospective first-time buyers are a function of high house prices. In the context of stretched public finances, it might be tempting to pursue whole-scale loosening of the regulatory system. But doing so, we think, would be risky and futile. Instead, policymakers should seek to remove inequalities within generations between those with wealthy parents and those without, by essentially providing a bank of mum and dad role through a deposit scheme and targeting support where it has the greatest impact. And that's it. Thank you very much.
All right, Sarah, over to you for your view on all things housing credit related.
And thanks very much, James, and thanks for having me here today, and thanks to the Resolution Foundation for doing such important analysis. Getting onto the housing ladder remains one of the biggest financial challenges facing younger generations in the UK, so it's great to be here for this discussion. Supporting the government's priorities on home ownership is part of the FPC's secondary objective. Now, there's a lot that lies under that issue and much isn't down to us. We don't build houses, we can't determine house prices, and so who can afford to own a house isn't something we control. But as part of delivering our primary objective of financial stability, we do operate tools that influence financing conditions for house prices. So a key question for us is whether, and if so, how much, our mortgage market measures might limit first-time buyers' access to mortgages. And so what I try and do is three things today. First, set out our analysis of the impact of our measures on first-time buyers, drawing on our big review that we did in 2021, as well as the latest data. Second, I'll explain how I think our policy supports first-time buyers. And then third, I'll touch briefly on a couple of tweaks that we've made over the years to best support our secondary objective. But spoiler alert, what I say and what Hannah says rather aligns. Let me start with some positives. Our analysis suggests that the FPC's measures have had little direct impact on mortgage access, including for first-time buyers. Looking over the past, it's clear that it's in periods of house price boom and bust that we've seen home ownership for younger households fall most sharply. For example, ahead of the GFC, rising house prices relative to incomes pushed up the deposits needed to get on the housing ladder, and during the crisis itself, mortgage availability fell sharply, driving a further decline. We saw the same pattern in the late 1980s and early 1990s too. I vividly remember arriving at the Bank of England in 1991 with talk of repossessions and negative equity being all over the news. Now, since the FPC introduced its lending tools in 2014, we've seen some recovery in home ownership amongst younger households. The number of first-time buyers reached just over 390,000 last year. That was an 18% increase on the year. And as a share of overall mortgage activity, in 2025, they accounted for more than half of all mortgages for the first time since the mid-1990s. I'm not suggesting that correlation is causation, but when we assess the impact of the LTI flow limit in our 2021 review, we found little evidence that our tools were materially restricting access for first-time buyers, even though younger, lower-income borrowers are more likely to borrow at high LTIs and so more likely to be affected. Importantly, there was then, there still is now, Hannah's just talked us through it, different factors influencing availability. There was and is significant headroom below our 15% limit. That suggests the flow limit isn't acting as a binding constraint on high LTI lending in aggregate. We also looked at the regional picture. While the 15% flow limit wasn't reached overall, there were big differences across regions. Nearly a quarter of first-time buyers in London had high LTI mortgages. The equivalent figure in Wales, Scotland, Northern Ireland, much of Northern England was less than 5%. Now again, that's not surprising given London's higher house prices, but for me it really underlines how factors other than the Bank of England's tools play a much bigger role in shaping mortgage availability for first-time buyers. Indeed, our 21 analysis, consistent with the work we've just looked at, shows that the constraints for the vast majority of first-time buyers is not affordability, it's deposits. That remains true in our latest data. Our version of the analysis that Hannah talked through suggests that just under 80% of prospective first-time buyers don't have enough savings for a 5% deposit on a typical first-time buyer property in their area. On our analysis, a small share, around 7%, are constrained by affordability assessments, LTI requirements, lenders' LTI caps, and around 15% are unconstrained. And of course, we need to remember what lies behind that rise in deposits. And here, our analysis suggests that the rise that we've seen since 2000 is largely about higher house prices. About 14% reflects changes in the mortgage market and lower average LTVs, but more than half reflects higher house prices, with the rest driven between the interaction between the two. And we get the same intelligence through our residential property forum. Large deposits, high house prices are the biggest barriers to home ownership. So that brings me to my second theme, the benefits that I think our LTI limit provides to first-time buyers. The LTI flow limit prevents households taking on too much debt, and that in turn reduces the ups and downs in the housing market. As history shows, first-time buyers are hit hardest during boom-bust cycles, meaning our measures should be a help, not a hindrance for them. And there are three areas in particular that I wanted to highlight. First, the LTI limit has acted as a guardrail against excessive indebtedness during the post-COVID period of rapid house price growth. Second, despite the major shocks of recent years, COVID, the sharp rise in inflation after the invasion of Ukraine, and the fastest increase in bank rate in decades, mortgage arrears remain contained by historical standards. And third, we haven't seen anything like the sustained increase in house prices and mortgage debt relative to incomes that preceded the financial crisis and in the late 1980s. House prices have risen, but without a matching rise in household indebtedness. Indeed, household indebtedness in aggregate is now at levels that we last saw in the early 2000s. So finally, a quick word on the tweaks we've made to ensure our tools remain proportionate and effective. We've always been clear that all measures need to be calibrated carefully, and that where evidence suggests they're constraining access without improving financial stability, we're up for amending them. And we've done that on two occasions. In 2022, we withdrew the FPC's affordability stress test. That was, I think, the red line on Hannah's chart. That had stressed every single mortgage to a rise in interest rates of 3 percentage points. And after our work, we concluded that this measure was duplicating protections already provided by the LTI limit and the FCA's responsible lending rules. And so we judged that removing it could modestly improve access without endangering financial stability. And that's exactly what we've seen in the subsequent evidence. And then last year, we changed how the LTI flow limit operated in practice in order to give individual lenders flexibility to exceed 15% in their own portfolios, so long as the system-wide total stayed within the limit. 9 lenders representing almost half of UK mortgage lending have made use of this flexibility. And both these tweaks were designed to ensure we continued to deliver our primary objective of financial stability, but in a more proportionate and more effective way, which in practice means a little bit of help on mortgage access. And indeed, by way of example, Nationwide have offered more than 50% extra first-time buyer mortgages under its Helping Hand scheme since we made that adjustment. Let me stop there.
All right, thank you very much, Sarah. So really interesting to hear your very granular take on what's going on in the housing market. So let's definitely come back to that. But for now, Sarah, give us your reflection.
Yeah, thank you so much. Thank you, and really excellent. And it's a pleasure to be here and congratulate the Resolution Foundation on this report. Anything that brings another dimension and focus to the need to think about how to support first-time buyers in our housing market because of all the life implications of that for citizens is really valuable. So I'm very pleased to be able to be here and share some reflections. I just want to sort of talk a little bit about building societies and what we bring and our role in first-time buyers, and then just perhaps focus on sort of 3 areas where we would like to see further progress. And I'm sure we can pick up on other themes in Q&A. For some of you will know, but building societies are basically customer-owned banks, and they are, if you like, they're very original people-focused lenders. The very simple concept is ordinary people came together 250 years ago in order to support lending to other ordinary people, and that same set of principles governs the way in which building societies operate today. We are real champions of first-time buyers. If you look across our membership, we're about 43% of all building society lending is to first-time buyers, and across the UK market, 35% of first-time buyer mortgages will be with building societies. So this is not a niche at all issue for our building society sector. It is absolutely fundamental on that scale. And if we just look further at where that particular first-time buyer lending goes, half of that lending from building societies goes to customers under 30. Just under half, to be fair, just under 30. 23% goes to buyers who have less than a 5%, as Hannah was reflecting, so who's less than a 5% deposit available to them. And 10% goes to first-time buyers who are over the age of 45. This is a changing picture of the first-time buyer in our economy, and important just to recognise that diversity. So look, our assessment is that, affordability is the issue. It's an aspiration, and actually we did some work, including with Neil, last year called The Missing Millions, and in that we identified, if you look back to 2006, what you might ordinarily have expected in terms of the numbers of first-time buyers coming to the market, something like 2.2 million people who you might otherwise have expected to take up that opportunity of home ownership did not do so, and our report's available on our website, and we happily talk about that later. I think our areas that probably we would want to focus on and see progress for more work definitely is in around regulation. And I really acknowledge, the changes that the FPC made, as Sarah has described, in relation to the treatment of the LTI flow limit last summer were very welcome. And in aggregate, that 15% cap remains the same, but there were specific exemptions allowed for those 9 building societies and banks, as Sarah described. And just in practical terms, what that enabled from a building society perspective was not just an increase in the volume of lending to first-time buyers, about 1,000 additional first-time buyer lending and mortgages per month from the building societies who are involved in that, but also critically a shift in the lending criteria. So all 3 of the building societies who are involved in that and continue to lend on that basis saw a reduction in their lending criteria, reduction in the income threshold, in Nationwide's case actually to a minimum income of £30,000. So it's not just about volume, it's about enabling the shift in lending criteria, really important to younger first-time buyers. Our case is we would want to see a continuation of that flexibility that was afforded. It lasts until June, and I know there's a live consultation at the moment about what may succeed it, and I think it's a really important instrument for us to think about, whilst of course retaining, given that 15% aggregate cap, retaining that sort of macroprudential kind of control in terms of financial stability and inflationary effects in the way that Sarah's described. Our argument actually is further, we think there's further calibration to the regulatory regime that's needed, including in the prudential space, and again, very happy to talk about that in question. And of course, the other significant opportunity we have with regulation is the FCA's own mortgage reform programme, which is critical. It's underway. We're expecting to see further proposals in relation to that in the summer. And that really will look and examine, we hope, forensically, the affordability test, because our judgment is that affordability test is very important, but it is a sort of a single solution. It assesses net income today is the sort of key requirement. And our view is, our experience is that actually personal circumstances are really very different. So, for example, a number of people will have incomes that are more lumpy because they're on contract work, whereas that might mean there's fluctuation in income that sort of test won't necessarily accommodate. Similarly, for example, young professionals, maybe at the early stage of their career, their income today will not necessarily be as strong as their projection for their income might be. So what we're arguing for is a much more dynamic approach to that affordability test. And I think that's a really significant point. There are other things besides, but I'm conscious I need to move on. I want to also raise another challenge as we see it, which is around not just availability, but awareness, confidence, and engagement. Now, we have just launched a first-time buyer campaign that we'll build over the course of this year. And we did some consumer research to support that. And what we found is over half of those we researched, young people, first-time buyers, just weren't talking to mortgage advisors or indeed their building society or their bank about the choices that may actually be available. Secondly, when we then put in front of those consumers who we tested with some of the examples of the flexible products that are available in the building society sector, and they are significant, 2/3 said to us that they thought that the prospects of perhaps moving towards home ownership were closer than that otherwise had been the case. So there is a real reality perception gap here, and our first-time buyer campaign, and others I'm sure, can play a really important part. So awareness is the second key point I want to make. And then we shouldn't forget at all, as has already been referenced, how the capacity in our housing sector. And obviously we look forward very much to MHCLG's long-term housing strategy, which we hope and expect to be published soon. Sort of smiles around the room. So maybe you know something I don't. But there's a really important, and the key for us there is it's not just the volumes again, it's about the nature of that housing. So a stat that my friend here, Paul, and I kind of often sort of refer to is it's from Zoopla from last year. Only 1 in 5 of our properties in the UK have less than 3 bedrooms. So we have an issue about the nature of the housing that is available, and of course its affordability, as well as the availability of lending facilities. Just to conclude, I suppose I really just want to emphasise the role that building societies play, and they are the pioneers of first-time buyer lending. Where building societies lead, banks often follow, and that's particularly the case with products like no deposit mortgages and also very low deposit mortgages. It is rent to lend schemes, so in other words, taking your rental income as a reference point for your ability to pay and therefore affordability, the sort of dynamism we want to see through the work that the FCA is leading, and many other income flexible products besides. I could list them all, I promise I won't. But a point I'm getting at is there is a real dynamism, innovation in the building society sector, which is relevant in terms of encouraging the breadth of product that really meets customers where they're at, not what the algorithm might say. And the other value of that sector is because it brings that competitive tension and therefore that encouragement for further focus in relation to first-time buyer mortgages, which is essential in the way that we're all agreed on in terms of being on this platform today. James, thank you.
Great, thank you, Sarah. And lastly, over to you, Neil. Give us your thoughts.
Thanks for inviting me here today. Normally I would turn up at these sorts of things with a whole load of charts, but I thought being the last person to speak, that was hostage to fortune.
We do the charts here, Neil.
And so, yeah, I mean, the topic of first-time buyers has been fascinating to me ever since I was trying to become one about 15 years ago, and even before then. The way I've tended to look at it is to broadly kind of categorise the affordability challenge that first-time buyers face into one of the cost of buying and the cost of owning, and the cost of buying being primarily the deposit, which is clearly the biggest barrier as highlighted by the research. And actually, up until maybe about 4 or 5 years ago, the cost of owning, if you managed to get past that barrier of buying, was actually relatively affordable. You were spending a relatively low proportion of your gross income on mortgage repayments, around 17% on average, according to UK finance data. And so it was actually, once you got over that barrier, the home ownership itself was very attractive, particularly when you were then comparing it to the cost of living in the private rented sector. The challenge we've got now is that clearly with higher mortgage rates, we've seen an increase in the repayment affordability as highlighted by the chart earlier.
Neil, I'm not sure your mic's working.
Oh,
do you mind holding that for me?
Sorry, testing, hello, yep, there we go. And so what we've actually seen since mortgage rates started rising in around 2022 is that actually to absorb those higher mortgage rates, we've seen that big increase in repayments as a proportion of income. And that's really been the main reason the main way that mortgage-based borrowers and buyers have been able to absorb those higher rates. But unfortunately, what it now means is, you know, as we started this year, we were thinking maybe mortgage rates were going to continue trending down. Maybe this year was going to be the year that we actually saw a sustained recovery in the housing market, how new build increasing and higher rates of transactions. But actually what we've got clearly over the last few weeks is a very different scenario than the one we were envisaging back in January, one where actually mortgage rates have started to increase again. And my concern right now is actually that there's far less capacity when we look at those people who are able to become first-time buyers. They're already stretched in terms of the mortgage terms that they have. They're stretched in terms of the repayment affordability, something that we haven't actually seen consistently sustained. It always has historically come back down. And so actually if we do see this period of higher mortgage rates continue for a sustained period of time, we may actually see that more noticeably impact on buyers' budgets that they're actually able to pay in the real world, and then potentially onto wider house prices. And so the concern is that actually we have done a lot to help first-time buyers, but they are actually doing so from a much more exposed and unsustainable situation in terms of their repayment affordability. So that's kind of my concern at the moment. I think there's been an awful lot of talk about the first-time buyers, and so I think it's also important to note that first-time buyers you don't sort of magically turn up as a first-time buyer. They have a life before being a first-time buyer and a life after being a first-time buyer. And so actually things like the state of the private rented sector are incredibly important in terms of people's ability to be able to access. You know, we're talking a lot about the lack of savings, and, you know, consistently whenever you look at the stats on the savings of private rented sector households, they're absolutely shocking, and you wonder how they've managed to survive the repeated shocks that we've had over the last 6 years or so. And so actually improving the private rented sector, improving affordability there is actually a key part to actually helping first-time buyers in the future. And equally, it's helping first-time buyers now. We need to do it in a way, in a sustainable way, without compromising the prospects of first-time buyers in future generations. It'd be quite easy to actually increase first-time buyers, well, maybe until a few weeks ago, in terms of actually letting loose. But as the evidence shows, all that does is increase house prices and potentially reduce home ownership over the longer term. And actually just one stat that I think is always quite interesting when we're talking about the 1980s, and particularly around high loan-to-value, small deposit lending. Back in the 1980s, during that boom period when an awful lot of people managed to buy their first home, around 40% of lending was at 95% loan to value and above. And half of that, so 20% of the total, was at 100% LTV or above. So effectively no deposit. So that period where we saw a massive increase in home ownership was based on a very unsustainable underlying lending criteria. And then obviously the impact and the scenario under which first-time buyers do manage to access the market then determines their ability to move on to bigger homes in the future, and also with things like longer mortgage terms, lending into retirement, actually what the situation and the challenges that we're facing with older households as well.
Great, thanks Neil. You might need to keep hold of the mic for the time being. There may be some fixing in a moment. All right, so let's take the discussion in sort of two bits. So let's talk a little bit about where we are today, how we got here, and then let's talk about policy for the future and where the housing market is headed. But we should start with the elephant in the room. So we've sort of stitched up a question a little bit here. So if I could ask Tom Rees to ask a bit about where we are today and what is going on right now.
Yeah, as you say, the elephant in the room is obviously the Iran war, and in terms of mortgage affordability, that might be a big factor going forward. So you and the rest of the committee said that you stand ready to act on Iran. The market reacted very strongly to that message. Is the freeze hikes that we have priced in by the markets, is that too far given the domestic backdrop? And I just wonder, if the war ended in the next week or so, what do you do in that situation? Would we have some kind of hangover in terms of energy prices? How would policy react to that?
And sorry, so Sarah's flipping hats here quicker than you can do that. So there's an MPC hat here, which is what is happening to interest rates, what is going on. But if I could ask you to comment also a little bit on what it means for the housing market as well, that was good. That would be great. That echoes a question we've had from Richard Parsington of The Guardian about what all this means.
Great, thanks James, and thanks Tom. Look, since the onset of the conflict, as you all know, quoted mortgage rates have increased by around 50 to 60 basis points. That reflects movements in market-based measures of short-term rates. Now, given the UK's exposure to energy prices, it's not surprising that expectations for bank rate have moved. They've moved up for other jurisdictions as well. But it's not the movement in energy prices in and of themselves that matters. Regardless of what the recent sensitivity of short-term rates to daily developments in the Middle East might suggest, you can't draw a straight line between oil and gas prices and the likely path for bank rate. Rather, while of course monetary policy will be influenced by the scale and duration of the shock, the response will reflect that only to the extent to which it impacts the likelihood of second round effects, and so the likelihood that inflation returns sustainably to the 2% target over the medium term. And what I wanted to emphasize there, Tom, was that really depends heavily on the context in which the shock occurs. Where we are now is very different to 2022, when we had the last energy shock. Right now, inflation would otherwise have been at 2%. Bank rate is, we think, restrictive. There's slack in the labour market and it's rising. And the outlook for activity was lackluster even before the energy shock. And all of that means that firms and workers are likely to have less pricing power, less wage bargaining power, meaning second round effects should be less likely. All that said, this price shock comes after 4 years of above target inflation, and there's huge uncertainty around the scale and duration of the shock as you described. And so it's on us to remain alert, given the need to manage the risk of second round effects taking hold. But risks are on both sides, and we'll be watching closely for signs of either crystallising. It's not wise to act before we have sufficient information. We'll learn a chunk more by the time of the April decision on the balance of these risks, both the scale and duration of the shock, its impact on firms' costs, and our conversations with businesses and what that means for firms' wage and price setting behaviour. And I think then we'll be able to better answer your question.
Right. And housing market.
So looking forward to the housing market, it's clear that there's going to be an impact on affordability because house mortgage rates have risen. But I think that then comes back to, is the market pricing the right amount of tightening? And as I said, we don't really have a good sense of that yet. What I think gives us some confidence from a financial stability perspective is that we have limited indebtedness coming into the shock. And just as we saw with the COVID shock with the increase in interest rates that we saw before, our analysis suggests that even with higher energy prices, even with higher interest rates, there should be enough resilience in the borrowers to stop the bust. We haven't had the boom, we shouldn't have the bust.
All right, that's very clear. I'm going to turn to Neil on the impact on the housing market in a sec, but just to emphasise there what Sarah was saying about the need to sort of wait and see for the MPC here. So there's a key uncertainty about how all this plays out, and that will obviously affect the policy reaction, particularly around those sort of second round effects. But Neil, on the actual impact in the housing market so far, we've seen a lot of. You touched a bit on this in your opening remarks, and we've seen the withdrawal of a number of products, and there's been quite a lot of publicity around all that. What are you seeing right now? What sort of effect? Who's going to be hit hardest? Is it first-time buyers? Is it people remortgaging? Is it should our sympathies be with the banks dealing with all this?
Okay, this seems to be working now, so that's good. So, I mean, the truth is, when you're actually trying to understand the current impact of any event on the housing market, is we're slightly always looking into the rearview mirror in terms of the statistics that are available. It's very difficult to know accurately exactly what's happening right now beyond press releases and tidbits of data that we get out. But clearly, the sharp rise in mortgage rates is going to limit some people's ability to access the market. In terms of activity right now, the housing market is highly seasonal. Spring tends to be the market that sets the context for the rest of the year. Any house price growth that happens during the calendar year tends to happen round about now over the next couple of months. And so, given what's going on right now, we may expect a more subdued or even slightly negative year in terms of both transactions and prices than we were expecting a couple of months ago. That said, I think it's kind of a continuation of what we've already been seeing. The housing market, even before the pandemic, was very much showing signs of being late cycle. The house price activity and price growth was in the Midlands, the north of England, and the rest of the UK. We obviously had the race for space post-pandemic boom, which drove a bit of activity nationally. But since then, again, we've seen a lot more activity in those markets, while the housing markets in London and the south of England have been particularly affected by the increase in higher mortgage rates. And that's largely because they are more dependent on higher loan-to-income ratios, which become more unaffordable as rates increase. And so the kind of geographic outcome is exactly what we think. And so I think what we'll see is a continuation of that geographical dispersion, with the Midlands and the north of England and the rest of the UK continuing to deal better with these slightly higher rates. I think probably in the very short term, the bigger impact is sentiment, and it will be, I don't have a great feel as to actually how that's going to play out. Clearly, the last time round, we were going from very low, record low mortgage rates to very high mortgage rates. The shock was really quite severe. This time, the experience is much more real in terms of having dealt with those higher rates. So potentially in terms of the sentiment, people might shrug it off a little bit. And actually, in terms of the activity, there will still be a large chunk of people who have actually got their mortgages agreed in principle. They've got those rates locked in. As long as they're honoured by the banks, then we could see a continuing activity holding up for a bit longer than you might otherwise expect.
Really interesting. Now, if there are any other questions on the kind of here and now and where we get to, shall we take one here? And let's take the one at the back at the same time. So let's do two.
Thank you so much. Really fascinating. Thank you all, particularly Sarah, at what I assume is a very, very busy time. You mentioned April and...
Sorry, can you just give your
affiliation? Oh, of course. It's Bruna Skarka from Morgan Stanley. You've mentioned April as a moment when you'll have a little bit more information about the duration and the severity of the shock. I'm a market participant, kind of, so I wanted to highlight that the markets very clearly took the minutes as thinking that the Bank of England will act if there are risks of second round effects, not just if the bank starts seeing second round effects in motion. So that's why at this point in time we have 3 rate hikes that are priced, April, June and July. So I was just wondering, how are you thinking about that balance? Is it just about the risks of second round effects emerging, or is it about actually seeing those second round effects perhaps in surveys of pay settlements, price intentions by corporates? Do you think you might have that information by April? And then my question actually was for Neil. He talked a lot about mortgage rates very briefly. I think Neil was the first speaker. It took half an hour to actually mention mortgage rates and bank rate in the context of affordability and housing. I think we talk a lot about regulation. We do not talk about the level of bank rate and what it does for housing supply as well. Home builders are not going to build if bank rates are not lower. So I was just wondering if you could maybe expand a little bit on that, if we could get Sarah's thoughts on that as well. Thank you.
All right, great question. And let's take this one as well, please. Thank you.
Yeah, thank you so much. Suban from Reuters. During the last big episode of gilt market volatility in 2022, there was a lasting impact on mortgage availability and rates. This question is for Sarah. Are you seeing any signs that LDI funds are facing margin calls? And have you seen any signs of fire sales of assets? And has the gilt market trading been orderly so far?
Sarah, you're very popular today. Risks and LDI funds. Those are 2 different questions, aren't they?
They really are. Let me deal with the LDI funds and forced selling first. There's been a functioning gilt market through a period of volatility, no evidence of forced selling, and our intelligence on the LDI market suggests that the measures that we put in place after the mini budget episode are doing their job of ensuring resilience of those funds now. On the question of the outlook from here, I'll say 3 things. Firstly, it's not wise to act before we have sufficient information. 2, we have to be alert to the risk of second round effects, because it is the second round effects that require a monetary policy response. But there are risks on both sides.
All right, and Neil, over to you on the what's happening to building right now, because there's a lot that's happening to building, although not a lot of building.
It's not great. Well, ultimately, developers and house builders have been stuck between stretched viability. The inflation shock was quite severe in terms of increasing the cost of building houses and flats. That looks like that's going to continue through this year, the scale of which is fairly uncertain, but it could be quite significant. And on the other side, yes, we have an unmet need for a large number of new homes, but ultimately we've got a house building market that is dependent on market demand, and market demand has been constrained, particularly by higher mortgage rates over the last few years. And ultimately, there's not enough people that can afford to buy the homes at the price that developers and house builders can afford to build them for in the current market. And so we've seen delivery being quite low, net additions running around about 200,000, new build completions about 170, 180 a year across England, well below the government's 1.5 million target, which, to be honest, was pretty daft in the first place. So I think this year was going to be the year that the house builders were maybe expecting demand to come through and start to build, not substantially, whereas now actually it's yet another reason to put off plans to delay committing large amounts of money to build new projects. So potential recovery, let alone any sustained delivery of large number of homes, has been put further back.
All right, really helpful. Now I'm going to heroically try and move us on to away from the war. I know you're all here for that, and a little bit onto where we're going with the housing market and the sort of policy type options that we might have. So we like a poll here at the Resolution Foundation. So let's start with the poll, and people can sort of think about that issue in the background. So. The question here is, what will make a big difference for the affordability for first-time buyers? So we like to push our own book a little bit. So we've got our starter deposit scheme that is up on there. But one thing that we've just been touching on is what's happening to interest rates and the effect of all that. So we could be in for higher for longer rates, and what does that do? Is that the biggest thing that will push house prices down and make housing more affordable for first-time buyers? Is it the government's build baby build strategy? Will they build enough to make this more affordable? Will we see a return of Help to Buy? If you don't like our scheme, others are available. And do people think? And this feels leading, but anyway, do people think a bonfire of financial regulation would be the answer to making house prices more affordable? So have a think on that. People should vote on what they think, and I'll ask the panel to comment on this. But let's do a question on Slido, and there are basically, these are for you, Hannah. There are basically a few questions here which sort of ask a bit about so not everyone's been convinced by us saying it's not Help to Buy, the starter deposit scheme. So there are a few questions a little bit in that space. So this is the multitasking that I told the panel about earlier. So so if we take the top one, Angelica, this is thank you. Angelica has bailed me out of my failing in my multitasking. So a few questions here, basically saying, are we doing the right thing in terms of focusing on starter deposits, and shouldn't we just be doing something completely different, or clobbering landlords, or so defend your policy.
Yeah. No, I think the clobber landlords is a very sort of appealing direction of travel in a narrative sense, and certainly as a renter myself. But no, I
think it's very parochial, these discussions.
We looked at because this research was focusing on like the lending constraints that first-time buyers face. We sort of, one way that you can help first-time buyers is essentially by reweighting the credit distribution towards first-time buyers by clobbering landlords and making it much harder for them to borrow to access a mortgage. We looked into this, and ultimately, you could do that, but landlords in buy-to-let lending, it's actually a fairly small share of the mortgage lending at the moment. So you can do that, but it ultimately won't really move the dial. But what we're trying to do with the starter deposit scheme is give first-time buyers greater ability to outbid those landlords for these properties. We're giving them we're reweighting the credit towards the first-time buyers without necessarily clobbering the landlords in that way.
All right, I think Neil wants to come in. Neil, you should just come in. You don't need to wait for me. Don't stand on ceremony.
I think the point here is we've actually done this already. Actually, if you went back and looked at bank and other lenders' predictions of where the mortgage market was going following the financial crisis, it was buy-to-let. That's where the growth was coming from. And actually what we've seen is a whole load of tax changes that have actually really dampened demand from buy-to-let. And actually it was successful in terms of shifting the market away from investors to first-time buyers in all but the most expensive of markets. The problem is in London, the investors have withdrawn from the market, but house prices are just so unaffordable that no one could afford to step in and replace them. And so actually we saw activity fall there instead. So I think we've done it. And back to my earlier points about the need to kind of look at the private rented sector, actually there's a limit to how far we can squeeze that while maintaining a sort of a a sector that allows people to live in it affordably.
All right, now I want to follow up with you, Sarah, on basically the sort of regulatory asks here. What else could we do? And you mentioned the FCA review that is ongoing and what might happen in that space. But one thing I wondered whether you might come here and say is that we need a return of 100% mortgages. If the deposit is the key constraint here, what is your view on that? What do you think should be done in that space? And if you could say a little bit about why we don't see more. So we've just seen this 98% LTV mortgage from Santander. There's a few more products appearing in that space. Would you like to see more of that activity going on?
So there is more of that activity, and if you look at some of the building societies, you will see that, including some examples of 100% LTV, 95%, 98%, etc., and also the deposit arrangements I have referenced. I wonder if I could just, so there's a space for that, yes. But can I just go back to the sort of to the lending side? And while I wouldn't, if I were voting, I would not be voting for a bonfire of regulation for the avoidance of any doubt. Regulation is critical for all the good reasons that we talked about. But I would be
slightly pejorative.
But I would be arguing for a bit more recalibration. I talked about the FCA and I gave some examples. Can I just go back to the prudential regulatory space in terms of lending capacity? So one of the other current consultations underway relates to leverage ratio buffers, okay? So we don't need to get too hung up on that. In simple terms, it's about the amount of capital you need to retain relative to your assets. And what our argument is for in my recalibration piece is really thinking carefully about the lender and their risk profile, and therefore whether it's appropriate to require some of that capital to be retained at quite the level it's being retained. Of course, it must be there for macroprudential reasons, but I'll give you an example. And it's one I've used in parliamentary committees. A couple of our larger building societies, Nationwide being one, I'm going to give you a stat. Basically, their analysis, which we will be giving in evidence to the FPC's review, is that if there were some changes to those ratios, without compromising at all, in their judgment, admittedly, an increase in moving up the risk curve, nonetheless, they would have available an additional £30 billion of lending. Okay, so if we're interested in finding ways in an appropriate way, a proportionate way, to get more lending capacity into the market, and then think about the criteria against that lending, as I was describing, then that will improve the pool of capital available for first-time buyers, and indeed for others, but particularly in this case, first-time buyers. So there are some things we can do, and I think the wind is at our back. I might like to, perhaps I'm being over encouraging there, but my sense is the door is open for that kind of consideration with the right evidence, and that is definitely something we should be doing from a regulatory perspective.
I can feel Sarah desperate to come. We've come to another committee you're on, haven't we?
That's right, PRC and FPC. So look, we are looking at those issues. There's a live debate that's happening right now, looking at leverage, looking also at whether the various bits of the regulatory capital framework are pointing at the same risk and being potentially duplicative. So yours is a great point, Sarah, and we're definitely going to engage in it. I guess kind of the thing that I always worry about, and perhaps it matters less for the building societies than it does for others, is just making sure that if we do reduce capital requirements, that then does go into lending as opposed to going back to shareholders, for example.
All right.
Not an issue for the building society sector.
Yes, indeed. I thought you might say that. So let's just briefly touch on the issue of building, seeing as we're looking forward. I'll come to Hannah first, and then perhaps Neil. So perhaps you can give our view at the Resolution Foundation of what we want to really see in this space when it comes to building. You can use the phrase "build, baby, build" if you want to.
I'd rather not.
Fair enough. That's just for me.
No, so the government's pursuing this 1.5 million target, which I think sort of is a great target to set. Like it catches people's imagination. It will galvanise the building sector in theory. But It's also like no one thinks that they're going to meet this target. Like all the expert commentators say that A, they're already off track, but B, it was an absurd target in the first place. But I think the government response to that could be, let's just throw everything at it. But like my concern is that sort of leads to kind of like a boom and bust approach. It's like, let's just try and get as close as we can to the target, but not really think about the housing market that we'll have after that. So you can do things like Help to Buy and really just spur people to build, but essentially builders get a bit addicted to this Help to Buy stimulus and don't know how to build without it. And what we would like to see the government to do is think about, well, rather than just focus on this 1.5 million target, it's like, how can we just get to a higher equilibrium where we build more homes every year for the next sort of 10 years and beyond, because that's what we need to be doing. And that's about thinking about how do we build homes in like our second cities to really improve growth as well.
Neil, are the government shifting the dial?
They've made some good changes, but ultimately I think I'd actually say the 1.5 million target, it needed to be even more ambitious and more crazy, because 1.5 to a relatively uninformed observer at the time would have looked achievable, and they've clearly set out to try and achieve it under the current framework of delivering homes. Whereas if we'd had a much higher target, they would have actually had to sit down and rethink how we actually commission and deliver homes. Now, underlying it is ultimately that there's a big challenge that we don't actually know who builds homes where, how, who funds them. There's no consistent data. I could bore you for an hour with a presentation about problems with house building stats in this country. And so there's a real challenge there. I think there's a lot of constraints in the system. I've already talked about demand. I think one of the things that we would have normally seen by now during a housing market downturn is quite a big housing program. Both in the 90s and following the financial crisis, we saw a lot of money invested by the government into the house building sector to convert market sale housing into rental homes, or be it private or social. It's effectively how housing associations got their start back in the 90s. There is the affordable homes program that's been delivered. We are starting to see some of that Section 106 delivery being announced. There's quite a bit of news flow there, but ultimately the numbers that it's tied to, the numbers that it will actually deliver are actually relatively uninspiring relative to even the 1.5 million. The shift to social rent is great, but it costs more money. And actually their overall strategy is fairly limiting. And actually, just a final thing on the housing strategy, I think the Secretary of State speech yesterday, the day before, meant kind of effectively pushed it out to the summer as the latest. We were expecting it spring, it's now summer. What I'd love to see is actually a strategy that sets out what it is that the government is going to achieve. Kate Barker said, what's the plan? Ultimately, what's the housing outcome that we want here, and how are we going to deliver it? And so far, I haven't seen anything that's particularly reassuring on that front.
I feel like the use of seasons in scheduling government strategy is become very, very common at the moment. All right, so I'm going to see if there's any final forward-looking questions in the room in a sec. So get those ready. Let's see the results of our poll. Oh yes,
Very good.
but still, starter deposit is definitely up there. So that's good. People are listening. There's some bonfire regulation in there, so some people do want that. But all right, let's take these two questions here and use that to wrap up.
Hi, my name is Olivia Harris. I'm Chief Executive at Dolphin Living, which is an affordable housing charity operating in and around Westminster. Hannah, thank you for your recommendation for a starter deposit scheme. It's something that Dolphin Living already do. We've got homes in Westminster that have been grant funded by the City Council, and at the end of a 3-year tenancy, residents receive a deposit towards the purchase of their own home, and it's been really popular and very well received. One of the barriers to that scheme is getting building societies and banks to accept the source of the deposit. And sorry, it's a bit of an off-piece question, but just be interested in the panel's views about what can be done to get banks and building societies. So it's probably mostly a question for Sarah Harrison. And then I think the other question I've got is, do we think that there are barriers in the transaction prices? There's a lot promoted by the government about removing stamp duty, and how much of a barrier is that towards first-time buyers, but also towards possibly people delaying a first-time purchase because they don't want the transaction costs, so they're going straight for a second home. And we can see that in the price inflation that we've seen in flats being much lower than, and I know that's partly driven by service charge, but there's a sort of another impact there, something that hasn't really been discussed.
Great, and one at the back there.
Hi, my name is Rita Taff. I'm a journalist for the Financial World. Do you have any thoughts on how sustainability, moving away from the gas network and towards well-insulated homes, feeds into all of this? And is there any role for local authorities in building more?
All right, so Hannah, you are going to take the sustainability of homes in a sec. Why don't we start with barriers, though, and you, Sarah? You seem to be writing away there, sorry.
So I'm writing the question down because I'm at an age where if I don't write it down, I'll forget. Look, I'll let Sarah Harrison talk about the barriers in practice, but I would say that these creative schemes where you're thinking about ways of bridging from a rental to a purchase, the role of charities, the role of housing associations, all of those are areas where we're seeing creativity. And I would encourage I'd encourage the financial institutions, where it's our regs that are getting in the way, do talk to us about it. It might not be intentional. It might have been created for a different world. So you know, well done. It's a great initiative.
So,
Oh, look, briefly, can I just say it is a brilliant initiative. I'm familiar with similar. I actually don't know this precise answer to that question. It's Olivia, isn't it? Yeah. But can I suggest we kind of link up afterwards? I'm very happy to chat about that. It could be a source of funds issue, but by the same token, I approve of. But by the same token, I'm aware of similar other schemes. So let's get into the detail. And if there is, as Sarah says, if there's a regulatory angle on this, then let's see what the opportunities are to break that down. Great point. Thank you. Great work.
And Hannah, on the sustainability question.
Yeah, I think it's sort of, there was an announcement yesterday about the decent home standards being higher and sort of the additional costs that might lead to building new homes. And like broadly, sort of we want to increase house building, and higher house building costs will make that slightly harder. But the UK has like really crap housing stock in terms of energy efficiency. And you don't solve that by building more homes that aren't energy efficient. So ultimately, I think like these sorts of changes should be welcome, but we really need to think about how we manage the overall cost of building a home. Because even though this is going to put the cost up higher, the point is that the cost is too high in the first place. So how can we manage those costs in the round? It's really important.
Great, and if we can just bring our poll up, and we'll wrap up. So if I can ask the panel to wrap up with what they think the big thing that might come onto the agenda in terms of what is affecting the outlook for first-time buyers. You know, what might change things, what they worry will change things, and what one policy thing they would like to change. I'm going to ask Sarah to do what risk you're most worried about in that space. But we'll start with Hannah, and then we'll go Neil and Sarah.
I feel I did my 10 minutes already. Essentially, I think the thing for the real sort of frustrating and unfair thing that you see in the first-time buyer market at the moment is the difference between those who've access to Bank of Mum and Dad and those who don't. And that's essentially what the starter deposit scheme is trying to kind of address. So that's my pitch. But ultimately, in the long term, it is build. It just sounds a bit crass otherwise. Yeah.
It's a new slogan. All right, Neil.
Yeah, well, my first point was complain about the lack of detail on the question, because there's clearly
that's the classic response. Attack the question.
There's clearly a time frame point there where build baby build is the solution, but that's one that manifests over many years, if not decades. And so there is clearly the need to help people right now, and you know, higher loan to value lending, be it via a deposit scheme or some other equity loan scheme. Historically, higher LTVs showed greater correlation with repossessions and people losing their home, getting into financial difficulty. The the kind of support networks that are available from lenders these days are very different to the ones that we had back in the early 90s. So there's a question as to how whether that be the case. So I think the increase in higher loan-to-value lending is a big factor, but right now mortgage rates are the binding constraint as of sort of 3 weeks ago, and that is going to continue to be the case in the short term at least.
Sarah?
Yeah, so look, I mean, I've said my piece on regulation, so clearly that would be my vote. And of course, build over the long term. I think, I mean, I really agree with Neil. I mean, the environment's very different in terms of higher loan to value, in terms of the regulation, the maturity of lending, the approach that there is a lot of competition for lending. There is a lot. And even though we are seeing a kind of pricing crunch, we don't see it necessarily right now. We're seeing which has of course given rise to some repricing of mortgages and indeed some removal of some from the market. We don't see it as a credit crunch, so we don't see the conditions as the same. There's intense competition for lending, and I think that's why I think the regulation is so important to really recalibrate it in a way that creates more capacity for that lending for the future.
All right, Sarah, I'm going to give you the last word.
Thank you. Look, as we pursue this really laudable aim of ensuring that first-time buyers are able to get the best possible access to the housing market, let's just be careful that we don't throw the baby out with the bathwater. And as we do so, we push house prices ever higher and create indebtedness that is not in the first-time buyer's interests, nor not in the system's interest.
All right, that is very clear and hard to argue with. So thank you to all our panellists. Let's just thank them for that. And thank you so much for watching. We did try and get off the wall briefly, but sorry we got back there. But thank you very much. Cheers.